So I would say the bottom line is a combination of a cautious Fed, persistent inflation, and rising political risk means that for now and for the foreseeable future, markets are going to be highly sensitive to new developments and will likely remain volatile.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
Welcome back to Converge Market Update. It is February 11th, 2025. I have George Vessey with me. Always great to see you, George. A lot is happening right now, but one theme continues to dominate: inflation, tariffs, and their impact on markets. Over the past week, we've seen persistent price pressures, shifting rate expectations, and ongoing trade tensions, all of which has seemingly kept markets quite on edge. So today we'll break it down from the latest Fed developments to the rising influence of Trump's trade policy and how all this is shaping the dollar and the global markets. George, let's dive in and start with the big picture, if you don't mind. What's been going on?
Hi, Alex. Good to be back. A lot going on right now, as you say. And as a result of this, of course, volatility across different asset classes remains elevated. But the main theme continues to be inflation. Even if we look at investor surveys, for example, we see that inflation and tariffs remain the main concern for markets, and recession risks have actually fallen drastically. So we believe the markets remain focused on how persistent inflation and the trade tensions that we're seeing have kind of evaporated those hopes of rate cuts from the Fed this year. On the data front, last Friday, we had the US jobs report that reinforced this narrative. So what we saw there was that hiring slowed, 143,000 jobs added versus the 175,000 that were expected. So a clear sign of a cooling labour market. But we also saw that wage growth remained firm, average hourly earnings rising 0.5% month on month. And that's keeping inflation concerns alive. And that was one of the main drivers of price action last Friday in particular. We also had some upward revisions, adding 100,000 jobs to previous months, and the unemployment rate held steady at 4% as well. So that was defying expectations of a rise. So to summarise that kind of macro picture there on the jobs market, the numbers suggest that while job growth is slowing in the US, inflationary pressures are persisting. And as a result of this, markets have pulled back expectations for Fed rate cuts, with options markets now pricing in only 2 cuts for this cycle versus the 4 rate cuts that were priced in at the start of the year. And some are even asking if we're going to see a rate hike if inflation expectations keep rising. And in other words, the idea of aggressive easing from the Fed this year is fading quickly. And that's keeping the US dollar supported, obviously combined with the ongoing geopolitical uncertainty that's given a bit of a haven boost as well.
Right. So inflation fears are back in full force, it sounds like. And this has got traders rethinking how much the Fed can cut interest rates. But tariff concerns are also to blame here, right? If we shift gears to trade, what is the latest on Trump's stance? It can seem to be a lot of on and off. But where are things today?
Yeah, exactly. I think this is the major talking point here. So we'll spend a bit of time on the topic. But you're exactly right. Tariffs are another piece of the puzzle. They're reigniting these inflationary fears as well and driving price action across financial markets, probably more so than the macro data that we're seeing, especially in the currency space. But focusing on Trump's latest comments. In fact, let's dive into Trump's world a bit more for some context, because Trump's favorability continues to rise, and he likely sees this as a mandate to enact his agenda. Yes, last week, on Monday last week, we had his decision to postpone those tariffs on Canada and Mexico, which sparked a relief rally naturally across markets, the improvement of risk appetite. However, on Friday, markets turned risk off again, as he suggested that tariffs could be reciprocal, reigniting fears of escalating trade tensions. And even late yesterday in the Asian trading session, Trump announced plans for a blanket 25% tariff on all steel and aluminium imports, and that's set to take place today, along with some additional tariffs to be revealed tomorrow and on Wednesday. And this all coincided with China retaliating as well on selected US exports, and that's set to take effect today as well. And also the German Chancellor stated that the EU was prepared to respond quickly if the US imported tariffs on European goods as well. So, like you say, there's a lot of on and off, back and forth going on in this tariff chat at the moment.
So we're back in full-blown trade war mode, it seems, yes?
It is looking that way, or at least like it's getting that way. I have to admit, though, that there is a lot of this tariff noise that's going on, and that corresponds to little action, really. Even today, we saw this interesting article published by Bloomberg revealing that tariff noise to signal ratio is 161,000 to 1. So in layman's terms, since the US election until last Friday, there's been a huge amount of news stories and headlines focused on trade policy. 161,000 of these news stories mentioning tariffs. And at the same time, we've only seen one single solitary tariff actually put in place. Of course, right now, markets are still highly sensitive to all of this news flow. And there's still so much uncertainty about the nature, the timing and the magnitude of all of these tariffs as well. So there could be the risks of retaliation, as I mentioned earlier. I think that's the major risk that we've got to bear in mind. If China or the EU or even Japan retaliate, then the global trade war that will surely kick into a higher gear that fuels inflation fears and forces central banks to rethink their policy stances as well. So yeah, this back and forth really highlights the increasing role of political uncertainty in shaping financial markets. And it has to a certain degree contributed to this kind of mini cycle that we've been in since October that we've witnessed. And that's when the dollar's really started to appreciate against the backdrop of the stronger macro data that we've seen, the lower Fed easing probabilities, and these rising tariff fears.
All right, let's talk about the dollar. It's been bid up again, despite some initial weaknesses after the tariff delay. What's driving that move upward in your view?
Two things, rate differentials and again, trade risks. So firstly, the Fed holding steady, not cutting interest rates as much as what was expected, whilst other central banks, like the European Central Bank, the Bank of England, both expected to cut further. So that makes the dollar more attractive relative to other currencies. Secondly, we've got the trade uncertainty. And when that rises, markets tend to pile into the dollar as a safe haven bet. And we're seeing that play out as well. But I think it's quite ironic, interesting to point out here about the dollar strength over the past few months or so, that it does contradict what Trump is trying to achieve as well. He does want a weaker dollar, as we know. And some data we had out last week, when we overlay the US trade balance with the US dollar on a chart, we have this inverse correlation between the two. And that data last week of US trade balance, it showed that the deficit in December expanded to the largest gap since March 2022. And this was driven by boosted imports that aligns with the robustness of the US consumer. However, the strong US dollar weighed on export growth. So, Trump's desire for a weaker dollar aims to close the deficit, but his tariff threats may not be aiding his cause. So maybe this will catch the administration's attention in the future.
Interesting. Would you say as well that the dollar is already trading at a premium? And how long do you think this can continue?
Yeah, good question. I think that the high valuations could limit further upside if inflation remains sticky and tariffs keep escalating. For sure, the dollar could stay stronger for longer, though, at least until we get a major shift in Fed policy. But that upside could be limited, like you say, just due to the fact of that high valuation. But really, market valuations are elevated more broadly as well. So we've got to look at it from a broader perspective. If we compare today to 8 years ago, markets are more in danger of a correction. Higher valuations, stronger 2-year performances leading up to the tariffs across different asset classes does mean that there's potential for profit taking, much higher yields and higher volatility to come. And then the second point to note is the scale of these potential tariffs, though, is unprecedented. So if we look back at 2017, 18, those tariffs were milder by comparison and a bit more concentrated. Now, the current proposals, plural, because there are a few of them out there and some of them are drastic, even the proposal of putting tariffs on China, Canada and Mexico, that could put the average US tariff on par with levels seen during World War II. Whereas a broad 10% world and 50% China tariff that was floated some weeks ago, that would put it at 90-year high. This is extraordinary, this kind of situation that we're in at the moment. It's not our base case. It's never been our base case to see this to such an extreme. but the probability of it happening isn't zero. So we do need to keep it in mind. So because with this risk and the safe haven flows as a result of this, we should see the dollar well supported. However, going back to your valuation point, yes, it is trading at a larger premium than it was 8 years ago. But not only are we in this really uncertain environment of tariffs, but we've got the strong US economic backdrop. Coupled with this constant tariff threat, it just means that the Fed might just have to stay on hold, keep interest rates as they are for longer. And that just clearly means it's difficult to sell the US dollar at this kind of stage.
Got it. Well, that's a great summary, George. A lot of noise out there. But if we were to just break this down and sum it up for our listeners, what are the key takeaways and what should we be looking forward to as we continue to analyze the moves in the market over the next couple of weeks?
Yeah, sure, Alex. Like you say, lots of noise. So try and keep it simple and summarize it. We do have a bit of ambiguity when it comes to the macro side of things. But as we saw, as I mentioned, we had somewhat weaker jobs growth that was offset by an increase in wage growth, upward revisions to previous jobs report. And that is one reason why the Federal Reserve is probably in no rush to cut interest rates. As a result of this, markets have adjusted their expectations. They're now only pricing in 2 rate cuts from the Fed instead of 4. Trump's tariffs have become a major driver of volatility, creating uncertainty that could disrupt global trade flows. And yet, finally, the dollar remains strong. It's benefiting from all of this, from the Fed repricing, the safe haven flows. And again, although high valuations raise the risk of reversals, it is hard to bet against the dollar in this environment. So I would say the bottom line is a combination of a cautious Fed, persistent inflation, and rising political risk means that for now and for the foreseeable future, markets are going to be highly sensitive to new developments and will likely remain volatile.
Excellent summary. Thanks again, George. We look forward to chatting more about this in the coming weeks. Take care, my friend.
Pleasure. Cheers, Alex.